for signal from Brian on the webcast. Good afternoon, everyone. Welcome to the West Virginia University College of Law, Understanding the Financial Market Crisis. My name is Anoa Changa, and I'm a third-year law student here at the College of Law. Today, I have the great pleasure of introducing three wonderful professors here at West Virginia University. Today's conversation is very timely. Every day, we are inundated with constant updates on Wall Street and its impending doom. We've heard of nothing but gloom and doom, of pending depression and other horrors, without any explanation on why does it matter to me. I'm not a stockbroker. I don't work for Lehman Brothers. I don't work on Wall Street, but why does it matter to me? And as the bailout plan failed on Monday to pass the House of Representatives, it was apparent that the greatest failure was the inability of political leadership on both sides of the aisle to explain to Main Street why this mattered. Now, we've heard that this isn't a perfect bill. It's not even a good bill, but it's a bill that we need, without any explanation as to why. Now, today, we have with us Professor George Selgin from the West Virginia University College of Business and Economics. Professor Selgin received his PhD in economics from New York University. He's also the BB&T chair in free market thought. A notable author, Professor Selgin has published many articles and books that I could not even begin to list for you today. He's published Central Bank's Godfathers of Easy Money, along with Currency Privatization, considered as an alternative to currency boards and dollarization. Sitting next to Professor Selgin is our very own Professor Andre Douglas Pond Cummings. Professor Cummings has mentioned to us a few times in class that he has been recently tapped by Senator Arlen Specter's office, potentially to help look into this issue concerning the financial crisis and deregulation in general. Professor Cummings has written on the issue of deregulation, publishing Still Ain't No Glory in Pain, How the Telecommunications Act of 1996 and other 1990s deregulation facilitated the market crash of 2002. Along with Ain't No Glory in Pain, How the 1994 Republican Revolution and the Private Securities Litigation Reform Act collapsed the U.S. capital markets. Professor Cummings received his JD from Howard University School of Law and teaches business organizations along with securities regulation, sports law, and entertainment law. And finally, but certainly not least, is Professor Michael Risch, who joined the College of Law last year in 2007 and currently also serves as the project director for the Entrepreneurship, Innovation and Law program, and most recently has started a new clinical program here at the law school dealing with entrepreneurship. Professor Risch received his JD from the University of Chicago School of Law, where he served as where he was an Olin Fellow in Law and Economics, as well as a Bradley Fellow in Law and Economics. In undergrad at Stanford, Professor Risch graduated with high honors and distinction in quantitative economics along with public policy. Professor Risch has written in the areas of patent law and intellectual property, recently with the forthcoming article, Everything is Patentable. I would like to now turn it over to Professor Selgin.
Can you hear me? All right, just making sure. My principal role on the panel is to talk to you about the nature of the crisis itself and what's behind it in the simplest terms, not to say that I could explain it in very complicated terms and understand it myself. I'm going to also talk about some of the factors that are alleged to have contributed to the crisis, and of course some that I think actually did contribute to the crisis. I'll leave the discussion of the bailout and other specific issues concerning particular markets involved in this crisis to the other panelists. So essentially the story begins with an explosion of mortgage lending and of subprime mortgage lending in particular, and the chart tells the story. As you can see, the subprime mortgage market really takes off in the beginning of the present decade. And I want you to note the peak in the originations, that is, the original creation of subprime mortgages beginning after 2002 or so, and culminating around 2005. The other line on this chart shows the share of subprime mortgages as a proportion of total mortgages, and as you can see, the subprime market became important not just absolutely, but as but relative to other kinds of mortgage lending. The other thing that was new and important in this story of the explosion of subprime lending is the extent to which subprime loans, instead of being kept by the firms that originated them, were bundled up and sold in a secondary market. And you can see here securitization rates for different kinds of mortgages starting at the beginning of the decade. And what stands out is the subprime mortgages, which is the solid line, the dark solid line, which really were not, securitization was relatively unimportant for them, but it became extremely important over the course of the years in which subprime lending was taking off. By the way, this particular chart shows combined subprime loans with so-called Alt-A loans or liar loans. Those are loans where there's inadequate documentation, and the reason is unfortunately, the source of these statistics puts them together. For our purposes, for the purpose of understanding what went on here, it's not so important. Now, these subprime loans were being sold, and they were sold to investment banks, to government-sponsored enterprises, notably Fannie Mae, Freddie Mac, and to other financial firms who ended up acquiring huge amounts of mortgage-based securities and derivative products based on the mortgages. Some $1 to $2 trillion in all ended up in the portfolios of these various banks and financial firms. So it's a huge amount of money. Securitization worked very well in the bundling of the mortgages involved in securitization. It was a great thing in principle. It meant that you had a broadened source of funding for mortgages. That's good. It meant as well that the riskiness of mortgage lending was reduced to the extent that the bundling up of separate mortgages diversified the risk of the bundle compared to any individual mortgages. And the result was, as long as the housing market was buoyant, these turned out to be remarkably attractive investments with very high returns. On the other hand, the bundling did not protect against the particular risk involved that the housing market collapses. When housing prices start to fall, the bundling of the mortgages doesn't protect the owners of the bundled mortgages from losses, because in the case of a falling housing market, falling housing prices, the fact that some borrowers are better off than others doesn't matter so much. You get a systematic increase in defaults. And the reason that's true is because suppose you have borrowers who can't pay their mortgage. In a rising housing market, their best bet is to sell. In a falling housing market, their best bet may be to walk away, particularly if they haven't put any money down. So in a falling housing market, the default rate goes up all around, and that's essentially what happened. And here you can see what's happening to the percentage annual rate of change of housing prices, peaking at around 14% at the height of the mortgage lending boom, and then collapsing to, well, minus 10% at the time the chart was drawn, but presumably a bigger negative number right now. Well, of course, all the people holding the securities based on these mortgages had to bear the losses involved in the falling value of those securities due to the increased default rates. And here you can see a sample of of what's happening to the price of subprime securities in the last couple of years. based on a particular series of securities, but you could show any of them, you'd get this similar plunge. It's important to realize that a lot of the financial firms that were accumulating these securities were investing in them on a highly leveraged basis. That is, that if you looked at their balance sheets, you'd see a relatively small amount of capital that was a source of funding for the acquisition of these securities, and a lot of short-term borrowings. In private investment companies, the standalone investment companies, for example, leverage ratios were typically over 30 to 1. And as we'll see for the government-sponsored enterprises, for Fannie Mae and Freddie Mac, the leverage ratios were twice that amount. What that meant in practice was that a relatively small reduction in the value of the mortgage-backed securities, say just 2 or 3 percentage points, could in some cases be enough to render the holders insolvent, because they only had to have their capital fall to zero, right, for them to be insolvent. The other part of the story is that as the value of capital eroded, it became even more necessary for these firms to try to rebuild their capital or reduce their liabilities, which meant they would sell off the securities at so-called fire sale prices, contributing to a downward spiral, because that would lower the values further and erode the capital of other firms. It was a kind of a beggar thy neighbor situation. For banks in particular, the situation was very bad because they were subject to particular capital regulations. So they couldn't let their capital ratios fall, and that in turn meant that barring new acquisitions of capital, they had to stop lending. They could control the liability growth more easily in many cases than they could get more capital. And so essentially you have a story of a downward spiral leading to a freezing up of lending of credit. And that was the situation that the federal authorities were particularly anxious to try and address. One problem was that the complete drying up of the market for these subprime securities caused their values, their fire sale values, to be presumably lower than their ultimate hold-to-maturity values. And the intervention is supposed to allow the discovery of the true or fundamental or hold-to-maturity values. And by establishing that, partly by buying lots of this stuff, the government hoped to revive lending in the financial markets. How's that so far? Okay? Yeah, sure. Well, that depends on whether the buyer has other kinds of loans and securities in the buyer's portfolio, right? But you're right. What was happening here was that the buyers of these mortgage-based securities were concentrated buyers. That is, they loaded up their portfolios with these things and not much else. And, of course, in that case, you don't have real diversification. You have more diversification than if you put your money all in one mortgage. Right? Obviously, you couldn't put trillions of dollars in one mortgage, but in principle, you're more diversified than that, but you're not so diversified as if you had investments that weren't based on mortgages at all, of course. Absolutely. Yeah. So I want to move on and talk very quickly, because my time is limited and the other speakers have lots of good stuff to say about some causes of the crisis. I have a list here of things that I want to talk about. Not everything on the list is necessarily as important as other things. But here it is, for what it's worth, factors that I think deserve some attention or that have gotten a lot of attention and therefore deserve some discussion. Easy money, regulatory encouragement of securitized subprime lending, irresponsible investor behavior, bad rating practices, lax regulatory oversight, implicit Fed guarantees, pro-cyclical capital requirements, and finally the bailout proposal itself. I hope I have time to say a little bit about each one of these. I think the easy money factor is very important. Now, I have to confess, I'm a monetary economist, so you might say, well, you would. But for what it's worth, it's important to bear in mind what the Greenspan Fed was up to in the years leading up to the subprime mortgage crisis. There was, as some of you will recall well, a dot-com collapse at the end of the 90s, and that was followed by a recession, which is shown on this chart as that vertical gray bar to the left. Now, that's the recession according to the official NBER, National Bureau of Economic Research Statistics. What the Fed did, which it often does, in the course of the recession, it reduced its the federal funds target rate in an effort to ease money and make for a so-called soft landing, right? Now, you have to understand, monetary policy has its effects with what Milton Friedman called long and variable lags. So sometimes what the Fed is up to is exactly what it should have done several months earlier, but absolutely wrong, given that the effects of its policies will actually be felt some months later from the time they're implemented. So here's the Fed, after the recession is over, getting rates as low as possible, and worse than that, holding them there. By late 2003, the rate is all the way down to a record low level of 1%, and it's held there through mid-2004. Right, so you see these very low rates after the recession is over, and long over. And by the way, 1% was actually a negative federal funds rate at that time if you adjusted for inflation, because the rate of inflation was more than 1%. In other words, financial firms are actually being paid to borrow money at this rate. Then you have, in response to, a belated response to the subprime boom, among other things, a gradual increase in rates. But as I'll argue, that's too little too late. This is nominal spending in the economy measured by final sales of domestic product. I'm going to say this very quickly, but I hope you'll take my word for it. Generally speaking, this is a good overall measure of the stance of monetary policy because it's a measure of total spending in the economy. This is actually the rate of change. And as you can see, it's high. It's above 3% for the whole period from 2003 onwards, and above 6% for the period coinciding with the subprime mortgage boom. And this is a lot of growth. Anything above 3% and persistently above that in domestic final demand is, in my opinion, proof of an overly easy monetary policy. Here you see the series for real estate loans, or their rate of growth, again, very, very high, much higher than the percentage rate of growth of total spending. So a lot of that money, a disproportionate amount of that new money that the Fed's pumping into the economy is going into real estate. And you know, with the credit is the fuel that fuels investment. In this case, it's the fuel being tossed on the fire of the subprime lending market. It's the fuel that's causing this conflagration to break out. Now, there are a number of other regulatory factors that help steer funds toward the subprime market in particular, and I want to discuss that. This is a list of some of the things that have been named: the Community Reinvestment Act, Fannie and Freddie, naive risk rating practices, and so on. Let me discuss a few of those very, very quickly. There was a lot of finger pointing, of course, when the crisis started to really become severe, and Republicans in particular tended to point the finger at the Community Reinvestment Act. I'd like to suggest that its involvement is relatively minor, but it's not completely innocent of any role in this crisis. The original legislation was passed in '77, far too early to have been responsible for the boom that we've been discussing. Now, it's true, though, that in 1995, revisions to the Act allowed securitization of Community Reinvestment Act loans, which was a provision first taken advantage of, by the way, by Bear Stearns. This is not a bad idea if you want to have more community reinvestment, and making the loans saleable extends the potential market for funds for these loans. And securitization isn't the problem per se. unfortunately, in the climate of the that we've been discussing, these securitized subprime loans proved wildly profitable, and when the rest of the market caught on to the fact that this was a great way to make high returns, it just took off. So the worst you could say about the Community Reinvestment Act is that they first tested this market and in a time when it was very attractive, and then everybody saw that this was a great thing to invest in, or so it seemed, as long as housing prices were very high. And that's about the only thing you can blame the CRA for in this, really. Sorry about that. I didn't mean to go ahead on that. Now, in turn, the Democrats like to counter by pointing a finger at Graham Leach Bliley. Right? This was the act in 1999 that reduced that repealed important provisions of the 1933 Glass-Steagall Act. Well, here I think the argument is even more tenuous. There's no clear link between the deregulations of '99 and the subprime lending boom. Not any that I can find. And in fact, the biggest losers in this crisis, or the firms that failed first in the first round anyway, are the very standalone investment companies that Glass-Steagall helped to preserve, and that Graham Leach Bliley allowed to combine with commercial banks. In essence, what the survivors have survived in the industry by doing what Graham Leach Bliley has allowed them to do, and what only that law allowed them to do. The damage would be even greater if that reform hadn't taken place. For what it's worth, and this will have to go to the questions session, the Glass-Steagall Act was a lousy act when it was passed, served no useful purpose, was very counterproductive. Fannie and Freddie, I'll be very quick, I only have a few minutes. They became major participants in the subprime mortgage boom, and participants whose securities were particularly attractive because of the guarantees that supposedly stood behind them, and in fact stood behind them. Everybody believed the Treasury would bail out Fannie and Freddie in the worst case, and that's exactly what happened. Consequently, when the market was rising, their securities looked better than Treasury bills and were heavily invested in by foreign central banks, among others. And the lesson there is that you get a lot more action on bad, dangerous securities when you take the risk out. Naive risk rating practices. I'm sorry I'm going so fast, but the wildly popular nature of the Fannie and Freddie securities doesn't explain why private market mortgage-based securities were so popular as well, because there was risk associated with them. Here's loans in foreclosure as a percentage of total loans, and the subprime loans are shown in the dark line. Anyone who looked at this chart could see that it was risky to own subprime mortgages. And so unless they were from Fannie and Freddie, okay? So the question is, why did they ignore this risk? And there are a couple answers. One is old-fashioned greed, I'm afraid, avarice, whatever you want to call it. It's hard to escape feeling that explaining what happened in terms of greed is kind of like trying to explain an airplane crash by pointing to gravity when you're dealing with financial market activities. It's true, but it's not very helpful. However, it's a fact that a lot of these investment firms just turned their back on old-fashioned risk management practices, even punishing executives who were pointing out the riskiness of what was going on. But that's a reason why they should take their lumps, because they did that kind of thing. It's very important. The other thing is the credit rating practices. The credit rating agencies, of course, were rating these things very high, even when their riskiness was becoming apparent. And all I can say about that in the time that I have is, don't blame the free market. The SEC has essentially created a credit rating cartel in which only 3 firms can participate. The rules effectively don't allow any new ones to enter. So the market has been stuck with those rating agencies. If other people had better ideas on how to rate these firms, they couldn't get a foothold in that business under current regulation. Oh well. I'm going to skip over a few more things. including, I'm afraid, lax regulatory oversight and pro-cyclical capital requirements and the bailout itself. I'll suffice to show you my last slide, which suggests that, after all, if you do, one danger of any bailout is it adds to the moral hazard problem and thus risks setting the stage for even worse crises in the future. So that's something to keep in mind. Thank you very much. Oops.
Welcome. It's good to see so many of you here today. I wanted to begin by expressing my appreciation to Anoa Changa, to George Selgin, and to Michael Rich for participating in this panel today. I also wanted to acknowledge Kim Murphy, my research assistant, who's helped me put these remarks together. I'd also like to acknowledge Dean Joyce McConnell and Dean Caprice Roberts, who have supported all of our scholarly and academic outreaches this semester, and it's very good to be here and to do something that I think is really important, which is to try to understand and get to the bottom of why we are where we are today. My talk is called Understanding the Financial Market Crisis, the Hidden Narrative, and I'd like to start by suggesting this. We are at a precarious financial moment in United States history. I say moment, and it's been going on for a few weeks now, but we're at a precarious time in our country's history. I've very carefully watched and listened and talked to individuals during this financial rescue talk, and I've been struck by what I think is a fairly constant narrative that we keep hearing, and this is the narrative. President Bush delivered portions of it in his speech to the nation on Wednesday, September 26th. President Bush said the guilty parties are overseas lenders flush with cash. The guilty parties are American borrowers reaching for more than they could afford. There's easy credit terms and a banking system that's eager to cooperate and too much optimism about rising home values. This is President Bush. He vaguely mentioned investment banks who, quote, found themselves saddled with toxic assets in banks, end quote, and found themselves with questionable balance sheets. As investment banks found themselves in these precarious situations. A lot of discussion on radio and television programs, including blogs, newspapers, and the like, focus on the failure of personal responsibility. The personal responsibility of borrowers, those of us that went out and decided, I need that home. I cannot afford it, but I need to get it, or that car, or that second home. Now, I don't want to ignore the fact that there were real estate speculators that engaged in reckless borrowing. But I would like to talk about the personal responsibility in the hidden narrative. The personal responsibility of investment bankers, securities speculators, and corporate executives, and the personal responsibility that conveniently is forgotten in much of the speech that we're hearing from Congress today. Few are talking about reckless trades and swaps that were made by these individuals. First of all, I think Professor Selgin did a very good job describing the subprime mortgages. In layperson's terms, a subprime mortgage is a loan made to a borrower who was perceived to have a very high credit risk, often because these individuals either lack a strong credit history or they have other characteristics that are associated with high probabilities of default. We keep hearing about these subprime mortgages and the fact that banks and individuals entered into these subprime mortgages regularly. Subprime loans are targeted towards borrowers with poor credit. They generally carry higher interest rates than conventional loans. Many of you probably know that most of these subprime mortgages allow you to get in easy, 2%, 3%, with a balloon after a year or two of making payments that take your interest rate to an incredibly difficult rate for individuals that have poor credit histories and that are living paycheck to paycheck to continue to make. These are the loans that were distributed freely by lenders in the 1990s and early part of this century. We had a subprime mortgage market that developed. which became these subprime loans being packaged. And Professor Selgin talked a little bit about how they were packaged into securities. What that means essentially is that all of these loans were grouped together. President Hardesty and Professor Selgin talked a little bit about how they were grouped together. Some of the subprime mortgages with other safe loans. And they were packaged together as securities and then sold to investment banks and sold to investment speculators as a way to make money. And what essentially happens when you securitize and sell these packaged securities is that the buyer pays the entire value of the underlying security, keeps the security, and reaps the interest as the interest rates continue to expand. And this is something that I did at my practice in Chicago, was we securitized General Motors auto loans and then sold GMAC loans to investors. And the default rate on auto loans in this country is like 2%. So most of us make our car note payment, right? We want to drive our cars, so we make our car payment. The problem with the securitized subprime loans is that the default rates are significantly higher than normal rates. And the idea as to why these subprime loans are even provided is because the higher interest compensates, right? The bank makes higher interest and compensates for the greater default rate. And so these subprime loans were packaged together and sold, and as Professor Selgin indicated, a bounty was made in the markets in the 1990s and the early part of the century on the interest that was created by these securitized subprime loans. So we have the subprime mortgage lending market that developed in the 1990s. Here's what nobody's talking about, except me and a few others. In the United States securities markets, and this has developed exponentially in the latter 25 years or so, we have derivatives and futures trading. Derivatives and futures trading is unlike the kind of trading that we're all familiar with. We buy a stock, right? If we go online, E-Trade, and buy a stock of Disney, a share of Disney, we know that we're owning 1/1,000,000,000% of Disney as a company. And as Disney profits and does well, our stock price increases. Disney pays us a couple of dividends across the way. That's the stock ownership that we're comfortable with and aware of, most Americans. Derivatives and futures trading is a completely different animal, which allows speculative betting or hedging, not on the security ownership, but on how the security is going to perform. There is such thing as short selling. There's such thing as options, puts and calls. There's an availability of hedging in these derivatives trading markets that has become mind-boggling. And these credit default swaps that I'm about to introduce to you has become a market that's extremely difficult to understand, but one that is at the underlying reckless base of this market scandal currently. Hedging began with this idea, right? If I'm a corn grower and Anoa is a corn buyer, then next year when the corn crop comes in, she and I agree that she's going to buy my bushels of corn at $5 a bushel. Now, we don't know what the market's going to be a year from now, but for me, that gives me some stability knowing that I'm going to get $5 a bushel going forward. It gives her some stability knowing that she's going to pay for that. One of us is going to suffer. If corn's trading at $3 a bushel, then that's to my advantage because Anoa's paying me $5 a bushel. But if it's trading at $7, that hurts me as the seller because I'm not getting $7 for my bushel, I'm getting $5. That's the kind of hedging that this country initially engaged in. Fuel prices. One of the reasons that Southwest Airlines today is still profitable is because they hedged gasoline fuel several years ago. So Southwest is paying significantly less for the fuel it buys for its airplanes today than other airlines because they hedged. And they purchased fuel at a higher rate 2 years ago, but it's a lot lower rate than what they're paying for today. So this credit default swaps trades on this principle or this idea. So now we have these securitized subprime mortgage instruments. And there became an industry for insuring or trading on the credit default in the swaps market. What that means is this. Certain companies, AIG for example and others, began to insure, if you will, by contract, the default rate of these securitized loans. which means that Lehman Brothers, that owns some securitized loans, goes to AIG and says, will you insure against the default for these subprime securitized loans? AIG says yes. Just like the insurance you're all familiar with, Lehman Brothers pays a premium monthly to AIG for insurance, and AIG, by contract, agrees that if these securitized mortgages fail or if they become worthless, we will insure you against the default and we will pay you for the value of those securities. That's the underlying idea of these credit default swaps. But what ended up happening, and what's breathtaking about this market, which is now in the trillions of dollars of trading, is that speculators and hedge funds began betting on the success or failure of the default swaps. Let me suggest to you what I mean by that. It's sort of like, I think Professor Rich is a bad driver, and I think he's going to crash his car. Now, in any insurance scheme that we know, he's the one that's buying insurance in case he crashes his car. But in this construct, I could go to an insurance company and I could say, I think Rich is going to crash his car. I want insurance on his car. And when he does crash it, sorry, Michael, but when he does crash it, if he's a bad driver, I get paid based on that speculative bet as to what he's going to do with his performance in his vehicle. And that's exactly what's happened in the credit default swaps market. When what started out as a vehicle for hedging, these default swaps, ended up giving investors a cheap, easy way to wager on almost any event in the credit markets. In effect, credit default swaps have become, in some folks' opinion, the world's largest casino, where speculators are looking at the securitized loans owned by these banks and betting that they will fail. And if they do fail, then they win the short sell that they bet on in those derivatives trading markets. So essentially what's happened in this credit default market is, let me mention one other thing. A big difference between trading a credit default swap and casino gambling is if we go to a casino and I bet $50 on black 22, if the roulette ball falls on black 22, I'm pretty sure I'm going to get paid. I'm pretty sure someone in the casino is going to pony up some funds because I'm pretty sure the casino's got money. What ended up happening in this credit default swap market is that startup hedge funds with very little capital were getting into the market and were buying up these credit default swaps without any assets to back it up. Okay? Meaning, Lehman Brothers wants insurance on its securitized subprime mortgages. It goes to the startup, gets a credit default swap, begins paying the startup premiums every month. Easy money, right? Because how are we going to, how likely is it that these securities are going to default? But when they do, and Lehman Brothers goes to the startup for the money to pay the insurance for this, there's no money there. It was startup hedge funds were engaging in the securitized credit default swap market without the assets to cover the obligations that they were making. How is that possible? How is that possible? I can't go to... This is how it's possible. In 2000, this is the best part of my talk. I wrote an article about this. In 2000, Congress had the chance to regulate over-the-counter derivatives market trading. You know what happened? No dice. Greenspan said, no way. Congress said it'll screw up our free markets. Derivatives over-the-counter trading is unregulated in the United States, meaning no disclosure, no review of assets, no requirement that these companies be capitalized in order to enter into these agreements. And we have a completely, to this day, unregulated derivatives trading market because in the Commodities Futures Modernization Act, Congress forbade regulation in these derivatives and futures trading markets. So, I return to my original question. Let's talk about personal responsibility. Okay, I get that some folks that entered into these mortgages shouldn't have, and their own personal responsibility leads them to default. But what about the personal responsibility of an AIG, corporate executives that bought incredible amounts of subprime securitized loans and made dozens, if not hundreds, of credit default swaps, trades, and agreements, only to see all of it go bad when there was no assets to back them up? What about the personal responsibility of the executives that engaged in this reckless, abhorrent behavior? Not hearing any discussion about that. What about the personal responsibility of Lehman Brothers, Merrill Lynch, that all dove in? The water was warm back in the 1990s and 2000. Everyone was making, as Professor Selgin said, money hand over fist in these securitized and in these credit default swaps. Everybody dove in, except for the few that didn't. Citi and a couple of others, which seem to be the ones now that are buying up the failing banks. But we had, in my opinion, reckless, egregious trading and behavior on the parts of executives at these companies in a completely unregulated environment that led us to a point where we are asking the taxpayers of this country to provide $700 billion to bail out failing banks. A couple of points before I turn things over to Professor Risch, the excellent driver. One, Congress can still decide to regulate these over-the-counter derivatives. And in fact, Christopher Cox, SEC chair, dyed-in-the-wool free market champion, is now talking about regulating derivative credit default swaps. And let me mention, I mean, just so it's out there, Enron's failure was Enron was an energy company, right? Gas in pipelines. Why did they fail? Because they ran out of gas to run through their pipelines? Speculative energy derivatives trading, unregulated, betting wildly that energy prices would go up and down. When their derivatives were unsuccessful, they tanked because they had invested so much in these derivative energy vehicles. Again, unregulated to this day. Congress needs to regulate these markets, in my opinion. A couple things. Congress on Monday rejected, by a slim margin, $700 billion bailout. Wanted to just make two comments on that. I read it, 109 pages. Started out as 2, then it became 109. The Senate's version was just distributed before this session today, 451 pages, and the Senate's going to vote tonight on that bill. Let me tell you a couple of things that were messed up about that, in my opinion. First, I've been advocating since I've been contacted by a variety of sources that there needed to be protections. I do think that there needs to be some type of bailout protection. I think there needs to be a rescue bill. But what I think needs to be in place are some things. One, an oversight board or committee that has oversight over the way that the Treasury Secretary and the administration distribute this bailout money. Problem number one with the House bill, there was an oversight board created. Any idea who was on that oversight board? Paulson, Cox, Bernanke, HUD Secretary, Comptroller. The bill called for the oversight board being the individuals that were begging for the bailout. It's an abdication of responsibility by Congress, in my mind. 2, you may have heard that the $700 billion was going to be tranched, meaning it would be distributed at a different time or level. One of the big deals that the Senate and Congress people were making about that tranched disbursement of monies was that it was going to be at Congress's discretion. $350 billion would be at Congress's discretion. At base, when the President and Treasury Secretary asked for it, the bill provided that Congress would approve it, and if they did not, it was subject to presidential veto. If the President vetoed, Congress saying no dice, the tranched money, $350 billion, needed 2/3 to override the veto, to be distributed, and second abdication of responsibility in the House bill. Third, the limit on CEO pay, one of my strongest points that I've been arguing over and over to anyone that will listen to me, is that the executives that engaged in what I term reckless, and egregious behavior could not be the ones, A, to oversee the bailout money in their own firms, and 2, could not, even if they turn the firm around, be rewarded with executive compensation or pay. Congress made a really big deal about the fact that they put in these protections for CEO pay. After reading the language, the limit on CEO pay and the ability to profit from this corporate welfare in Section 111 of the draft bill is subject to the Treasury Secretary's discretion. Paulson got to decide whether or not the CEOs were paid or not paid based on their ability to help the company recover. I looked at the House bill as an abdication of responsibility to the taxpayers. Now, I understand there's urgency. Let me describe one last thing in this urgent environment. While decrying the irresponsible nature of the borrowers in the subprime mortgage scandal, we must honestly investigate the role that predatory lending played in the subprime mortgage market. Predatory lending. Lending to individuals when the banker knows that this individual cannot repay. The American dream, right? Apple pie, home ownership, football with the kids on Saturday. Home ownership, to me, is a lot less an irresponsible reach than reckless trading in an opportunity to try and secure greater profit. And all I'm hearing is talking about consumer irresponsibility, and I'm not hearing much about corporate executive irresponsibility. Last point. It is my hope that Congress can carefully and thoughtfully pass legislation that calms our troubled markets, opens our stalled systems of credit, and refuses to reward the corporate executives, which are a monolithic cultural elite that refuses to diversify. Congress needs to be careful. And my hope is that the Senate bill will be read carefully by Congresspeople and that folks will listen to these points and recognize the reckless credit default swap trading that led in part to this market collapse. Thank you.
Good afternoon. It's great to see so many people here. While you are here, I want to make clear I've not been in an auto accident for many, many years, so you will have to take your bets elsewhere. Other than that, I would like to echo the thanks that Professor Cummings has said, and given that we're short on time, I will not repeat them. It falls to me to discuss the actual bailout bill, which is no small task because it changes about every 15 minutes. And the new one came out today. Unfortunately, I have this thing called classes, so I have not yet read the 450 pages. So my comments are based on the 110 pages that came out on Monday, and I will not recite to you all the details of the 110 pages. I'm going to assume here that we need a bailout. That's a whole other discussion that we don't have time to talk about here. So now I'm going to talk about the bailout itself and some questions that I had about it that I'll share my thoughts with you. First, the bill. What does it do? It gives the Treasury Secretary discretion to buy what are being called now toxic assets from failing companies. These toxic assets are basically the securitized mortgages. You've heard Professor Selgin and Professor Cummings talk about those. They're toxic because nobody wants them, and they have little value right now. A second part of the bill allows for these assets to retroactively be insured in case they fail. If that sounds by the government. If that sounds familiar, Professor Cummings just described how private companies were doing that insurance, and now House Republicans and whoever else was discussing this got the insurance added so the government would pay 100% value if the securities failed in exchange for a premium. I'm not going to talk about the merits of it, but if you consider what Professor Cummings just said, you can probably come to your own conclusions about that. What was interesting to me about this process is both the legislative process and the bailout process. And so I asked myself 10 questions that I thought you might be wondering, and I came up with a few answers. These are not complete answers. I'm sure there's a lot more that can be said. I'm sure people may disagree with me on some of them, but here they are. Question number 1, why do we need legislation at all? Why doesn't the Secretary of Treasury just do this? There are a few answers to this. First, the authority for the Secretary of Treasury to go out and buy assets on behalf of the government is unclear. There's precedent. On July 30th, there was similar legislation for the Secretary to purchase assets of Fannie Mae and Freddie Mac, and as we know from that bailout, that's exactly what happened. Second, Congress governs the purse strings, appropriations. Arguably, we need legislation so that the Treasury has appropriations to buy up these assets. Third, to the extent that these purchases will be made out of the public debt is not high enough to pay $700 billion. There needs to be an authorization to increase the public debt, and that, too, is in the bailout bill. Given that the bailout bill failed on Monday, and we don't know what's going to happen to it now, the Federal Reserve could still lend money in emergency situations, and it's a questionable what they can do in exchange for that. Can they take warrants or stock like they did with AIG? That's kind of an open question. A lot of people think probably yes. A lot of people think probably no. But it's much better to get Congress to sign up. And that is exactly what Secretary Paulson tried to do with his 3-page bill that gave him unfettered power. So that leads to question 2, which is also about the legislative process. Is this rushed approach to the bailout an appropriate means of legislating something so important? And what I have to say about this is counterintuitive. I actually think it is. And here are a few reasons why. First of all, there is a legislative process going on. The bill started at 3 pages. It went to 110 pages. It ballooned to 451 pages. People are paying attention to this. All minds are focused on this. It's all we've heard about for a week. The rushed nature of the bill, I believe, leaves less time for lobbyists to get their hooks into folks and to generate controversy and changes in the bill. That doesn't mean that lobbyists aren't there. Lobbyists are going to be part of it. I'll discuss that later, but they don't have as much time. And in fact, if you look at the analysis of who voted against the bill on Monday, it had nothing to do with their party. It had nothing to do with lobbying. It had to do with whether or not they were in a close race. And so lobbying had very little effect on that. Also, I don't worry about the rush so much because Congress is not determining what to bail out right now. They're just trying to determine how and how to oversee it. That is something that you can define very quickly. Now, you may not like the way they defined it, as Professor Cummings said, and I'll discuss that later as well, but it doesn't take that long to come up with a structure that works. Many important bills that are voted receive far less attention by committees and on the floor, and so there is an argument that the number of minds focused on this makes this bill far better legislated than many. That said, there's value to the normal fact-gathering and committee consideration of bills, along with transparency and development of the law. For example, wouldn't it be nice if we had some committee meetings with fact-finding testimony about why we need the thing in the first place? Most people are saying Ben Bernanke says we need it. He knows a lot of things. The other federal people know a lot of things. We probably need it. And there are objective indicators that say we probably need to bail out. Interest rates are skyrocketing, et cetera, but I'm not an economist, so I won't address that any further. Finally, I'll say the fact that the bill failed shows that the failure to go through the normal process may have failed to reach a solution. This is why you need to often go through the regular process, so that when you get something to the floor, you've got something that everybody can live with. Third question, what is the role of the executive in negotiating this legislation? Obviously, the role of the executive is important. Treasury is leading the charge. President Bush has made a speech. He's called the presidential candidates to come and consult on it. It is using opinions from the Federal Reserve Bank. It provided the first 3-page draft. The executive is really leading the charge. The question follow-up, call it 3A, should we be concerned about this? As I discussed below, since it is the executive that must implement it and make the decision, we definitely need input from the executive to make it happen. The executive should be involved. When you're taking high school civics, they always say the president submits legislation to Congress. Well, here's an example of that happening. This is the legislative process working as it should. Question 4, should we worry about lobbyists? As discussed above, earlier, I tend to think that lobbying plays a minor role here. Lobbying's major role is going to be with the Treasury Department on who to bail out, how much to pay, etc. That said, lobbyists are definitely interested in the structure of the bailout and in other issues such as this insurance. They've had inputs on things like the executive pay and mortgage loan reductions in bankruptcy, which at least earlier were not being addressed. This is an issue that many people think should happen, which is the subprime mortgages. People are saying if somebody declares bankruptcy, they should be able to renegotiate the interest rate in what's called the cram down in bankruptcy, where basically you're going to lose all value if you don't agree to a lower interest rate, and thus there would be fewer defaults, and that would be a solution. That did not appear in the earlier bailout bill. I don't know if it appears in the one today, but lobbyists had a big role in that. But I still tend to think the secrecy, speed, and scope of the bailout means that lobbying is not going to have as much influence as they would have during a longer process. Coming from my IP experience, there are some bills that lobbyists basically wrote. So you have the lobbyists for industry on one side and lobbyists for free information on the other side negotiating the terms of the bill, and then Congress votes on it. That's really not how you want to have your legislation. Question 5, why must the executive implement and oversee this and not Congress? There are 3 reasons for this. The first is kind of important. It's constitutional. Congress may not exercise executive power. Even if each deal, quote unquote, each buyout of toxic assets were legislated, the executive must still carry it out. There's case law on this that oversight committees, as Professor Cummings thinks should be there, cannot be members of Congress in their individual capacities. So if there's going to be oversight, it must be from the executive or outside of Congress. It cannot be Congress. Number 2 is time. Look, it's taken 2 weeks to figure out how to do this. Now imagine if we had this kind of debate before every single purchase. These decisions have to be made quickly, before failure, and the reality is Congress is just not equipped to handle that type of quick process. The third is expertise. Say what you will about the executive. They have a lot more expertise than individual members of Congress in monetary policy. The executive has the Federal Reserve Bank, who theoretically, and I believe absolutely, has the best interests of the country in mind. Whether or not they're able to execute it in a way that works best is another story, but their hearts are in the right places and they are focused on it. Congress just does not have that expertise. The sub-question, call it 5A, is will we have more or less lobbyist influence on particular deals? I don't know the answer to that, but it's definitely a question we want to be asking. But at this point, I don't think we have a choice. The executive has to do it, and the real question is how much discretion do they get? Question number 6. This is more the bailout process than the legislative process. Should the government be in the investment purchasing business in the first place? It's typically avoided, though not unheard of. I'll give you a few examples. Number 1, universities get to own patents that are created using university grant money under the Bailout Act. It didn't have to be this way. The U.S. government could own a bunch of patents based on grant money. Another one is the government routinely seizes property and liquidates securities in bankruptcy or in conservatorships, let's say banks, and sells those things. The government has an arm that buys securities and sells them right now. Further, the government has had foreign investment, for example, during World War II Reconstruction and thereafter. Also, individual government agencies buy marketable government bonds right now. Another example is the FDIC. They take over banks and run them until their assets are sold off or the bank just closes. Another example is the post office. Now, of course, that's not a model of government-run business for efficiency, but the government is in the business of delivering mail every day, and there's a large volume, and they do it. Another example people may not think of, Amtrak. The government owns all the preferred shares in Amtrak. They own a railroad company. Not unheard of. A lot of countries have what are called sovereign wealth funds. They are the ones buying up a lot of these assets. They're the ones leaping in to invest and buy out our companies because our own U.S. companies won't do it. And the sovereign wealth funds are there to make money for their governments. There's no reason why the U.S. government couldn't get in that business. And so the last thing I'll say, at least from a government investment perspective, is arguably the government is the right entity to do this, because right now the problem with these toxic assets is nobody wants to buy them and nobody knows what the long-term value will be as foreclosures increase. They're not all worthless. They're not all worthless. So arguably, in the long run, they will have some value. The government arguably has the longest outlook of any entity out there in the U.S. The government's going to be here, hopefully, for a very long time. They can hold these assets. Now, there may be problems with having the government hold these assets, economic problems that I'm not going to get into, but the idea of the government buying these investments and holding them for the long term is not unheard of, and I'll describe that a little bit more with another bailout process question, which is, what about pricing rules? How do we determine how much the government should pay for these? This is one of the biggest areas of dispute. How much the government pays to buy these toxic securities will affect how much burden the taxpayers ultimately bear. Right now, the plan gives significant, almost ultimate discretion to the Secretary of the Treasury. If the government pays too much, then the assets can still be sold at a loss. Even so, the future ability to sell means the taxpayer will not pay the full price. Let's say the government buys $700 billion worth of assets and only can sell them for half as much as they paid in 2 or 3 years. The total cost would be $350 billion plus interest. So while $700 billion is a large amount of money, the real question is, what is the future value of these assets? And I don't think people know. And the government apparently is willing to take that risk. Of course, it would be better to pay $350 billion to start, but there's a risk of the government paying too little. If the current holders of these assets receive too little, they might as well be worthless. Indeed, that is the real problem with quote-unquote market prices, which a lot of people have said we should pay market prices for these. I'm sure there is some buyer somewhere willing to pay something for these securities with long-term investment in mind. Warren Buffett put $5 billion into Goldman Sachs as an example. He was willing to bet on the long run. The problem is that companies are just unwilling to sell for that low of a price. I'm sure if I offered them $1, they'd, if they were willing to sell it, there's a market, right? It's the same reason that houses sit on the market for months and months and months. There is surely someone out there who will buy the price at some house. At some price will buy that house, but not at the price the seller is willing to accept. So arguably there's no need for the government to step in unless the amount paid by the government is more than a true market price in order to effectuate a quicker sale to free up our credit markets. If the government is going to pay a market price at an auction, you don't need the government. Just have an auction and somebody else will buy it. Also, from a contractual point of view, to the extent the government pays more than market value, they can demand more from the company, more in stock, more in warrants, et cetera. If they're paying market price that could be gotten at an auction from a private company, then the government has much less argument that it should be taking ownership of some of these companies, although we may not want them to take ownership. An alternate mechanism plan is the insurance I discussed. Finally, we want to have some sort of automatic mechanism that we trust will yield objective and repeatable results. The bill tries to have this oversight panel. It doesn't really work. Hopefully this new bill has something. I think I'm running out of time, so I'm going to hurry up. Question number 8. How can we legally effectuate executive pay cuts? 3 things in the bill. Number 1, require institutions to establish rules if the government incurs debt or equity position. This is a spending clause power. Whether you believe it works or the discretion, Professor Cummings has his doubts, I tend to myself. Number two, here, institutions are not allowed to hire new executives in certain cases with golden parachutes, let's say. And number three, if an executive earns over $500,000, you can't take a tax deduction. Theoretically, this proves as a disincentive, but $500,000 is still a lot of money. What incentives do executives have to take a pay cut? Well, hopefully they have the best interest in their company in mind. That's called fiduciary duty. I'm running out of time, so I won't say more. Number 9, what about judicial review? Review under the bailout plan is under the Administrative Procedures Act. That is arbitrary, capricious, abuse of discretion, or not in accordance with law. The problems with this: number 1, the Treasury is given wide discretion, so I don't know how that would ever be met. Number 2, given quick action but slow litigation, it's hard to get any meaningful judicial review. Number 3, most important, the bill says no injunctions for purchases of assets. So the government can purchase the assets. It may be arbitrary and capricious. That's great. I don't know who's going to sue the government for damages, but nobody can sue them to stop the sale. I don't know who'd have standing. Whole other story. Number 10, and then I'm done. Now that the bailout failed, what do we do? If you know the answer to that question, let me know. Let your representatives in Congress know. Let President Bush know. I'm sure Secretary Paulson and the Fed and Wall Street would like to know because they're still working on it. So with that, I will yield to Ms. Changa, and we'll go from there. Thank you.
At this time, we'd like to turn it over to you, Main Street, and see what questions you have for our panel. Come on. I know. 2 weeks of this. Somebody has to have a question.
Lamplighter Drive.
I'm from Side Street and Back Street. I heard you guys blame Wall Street and Main Street. But what about Paulson, the Treasury, the government, in terms of the U.S. being the world's biggest debtor and the influence of our financial dependence on foreign investment? That was a big influence, in my opinion, but I've never heard that being discussed on the TV waves or by you guys. In your opinion, was that a big influence in this situation that we got ourselves into? Because the U.S. was running surpluses in the late 90s and the early 2000s, and at that point in time, we did not issue as many treasuries to foreign investors. So therefore, they turned to these mortgage securities. And when that, because they had higher yields, and the government now says, hey, we have fears, the central banks of these foreign countries are putting pressure on us to protect their interests. Did that come into play, in your opinion?
This country's been a debtor in the past. This is not the first time we've been net debtor. Yeah. If you allow me, that's just the first few words of my answer to your question. And we did not have a crisis like this. Foreign investment per se is not a bad thing. Presumably, you could preclude foreign investment altogether, and by doing so, preclude investments that go sour. The real problem here is the lack of a number of policies that contributed to these particular investments running wild, and to the lack of responsibility for failure being adequately assigned. I don't think you can blame the foreign governments or foreign markets in particular any more than you can blame other investors. I think that the real problem consists of poor incentives. Now, these poor incentives run the gamut. There are some in the companies, investment companies themselves. There are some with ultimate lenders. There are, including bank depositors. There are poor incentives on the part of the government. There are poor incentives in the oversight. I don't think that blocking off foreign investment would be the right solution or that it's the ultimate problem. You might as well say we should let everybody invest a little less and they can't invest so badly. Well, the answer is that if you say, look, a lot of the investment that went on here that's now gone sour was from foreign investors. Therefore, if we didn't have so much foreign investment, we wouldn't have had so much malinvestment. Well, it's true, but the problem isn't investment per se or foreign investment per se. It's a set of incentives that has caused bad investment to go on. The foreign debt, whether you think it's a bad thing in itself is a different question, but I don't think foreign investment per se is the problem. We could have had a bubble and a bad one even without foreign investment. Sure, but remember that. Yes, absolutely. I don't think that necessarily would have happened, but I do think you're right in saying that this is a big consideration in the bailout proposal. But let's remember that these securities became wildly popular with central banks, largely because they were perceived to be risk-free, and there the role of Fannie Mae and Ginnie Mac and Freddie Mac were very important. Normally, those central banks would have bought treasuries, and Paulson would have been very happy to have them buy treasuries. But these were like treasury securities, but with higher returns until the market turned sour. So yes, Paulson's concerned about the foreign demand for these securities and the effects it'll have on foreign central banks. But when they go down, it's not going to be good news for us either.
What I might add to that is that I was keeping a really close eye on this maybe 18 months ago or so when, before the subprime market debacle, Paulson and the Bush administration were arguing that foreign capital were fleeing the United States based on too much regulation. And this was in an attempt to roll back Sarbanes-Oxley. This was an attempt to further deregulate what I argue is an already too deregulated market. And they did a whole, this thick of a study claiming that foreign investment was fleeing the United States because of litigation and because of regulation. And so, I tend to agree that policies have been set. I tend to agree that policies have been set based on fear of losing foreign investment and trying to capture it and keep it here in the United States.
I have no comment.
First, I'd just like to thank the panel for joining us today and enlightening us on this complex issue. And my question is a broad one. It's for any of you, but it does point to Professor Cummings' point about personal responsibility, about the toxic assets on balance sheets of banks and investment firms. And you just touched upon a little bit in your answer to the last question. But my question is, in your opinion, how is it that we were able to get to this level of misinformation and manipulation on the balance sheets of financial firms in a post-Sarbanes-Oxley world to begin with? Thank you.
I'll take that first. Sarbanes-Oxley was enacted in a rush to deal with the Enron WorldCom debacles, which were viewed as accounting fraud. And so Sarbanes-Oxley really is about accounting, oversight, and in my mind, while some call it regulation and needless regulation and too much regulation, Sarbanes-Oxley never really got at the root that I think led to the market crash of 2002 or at the root of what's happening today, which is that the two things. Mr. Skorskowski. One is that this derivatives trading and this futures betting is a rapidly evolving market. It's $54 trillion are caught up in credit default swaps right now that can plummet in moments. I mean, so how did it tank so quickly is the fact that when you're betting on futures and you're betting on short selling. Remember, the SEC banned short selling just a few days ago. That's where investors can bet and make money on the plummet of a stock price. And so when a company starts tanking, you've got to believe the short sellers come running, and they're banking on further tanking of the markets. So the astonishing speed in which this happens is of no surprise to me in these futures and wildly speculative trading markets that are unregulated. And in answer to your question about Sarbanes-Oxley, my own view is that Sarbanes-Oxley doesn't get to these unregulated markets. My whole argument in an 80-page article a few years back was that Sarbanes-Oxley was a knee-jerk reaction to try and calm investors' fears without even getting close to the root of the problems that led to the market crash in 2002 and our debacle today.
If I may follow up on that, let's call a spade a spade. That was a regulation. It is a regulation. Just because the results aren't very good doesn't allow you to sweep it aside. And that regulation hurt. That regulation was responsible for the mark-to-market practices that required financial firms recently to value their assets not for hold-to-maturity prices, which is where the government would like to help them value them by paying $700 billion of taxpayers' money over to them. They could do it by themselves if the accounting rules didn't prevent them to, because they were revised to address a problem that had happened outside of the financial industry. And the SEC, of course, recently relaxed that requirement of mark-to-market, allowing something like hold-to-maturity valuation of the assets. The stock market went up 450 points, gaining back half of what it lost the day before, just as a result of that change. It's a lot cheaper to do that than to invest $700 billion, not to say that it has solved the problem. So one of the things, the repeated references to the lack of regulation in talking about this crisis ignores is that, no, we don't have an unregulated free market in finance. We have lots of regulations, and a lot of them have contributed to this problem. We've got a regulated money supply. You saw how well that worked. We've got regulation that protected standalone investment banks, dinosaurs in retrospect, that would have been better off if they had merged as the Graham legislation would have allowed them to. Got regulations that created the biggest players in the mortgage-backed securities market and then guaranteed lot holders of their products against risk at U.S. taxpayers' expense. We've got regulations that gave incompetent rating agencies a monopoly, precluding any new entry into that market. We've got regulations that forced banks to value assets at fire sale losses when previously they would have done otherwise, and it would have helped, because the capital regulations we also imposed on that bank those banks forced them to have to stop lending as soon as the capital valued at mark-to-market dried up. We've got regulations that prevent hedge funds from recapitalizing troubled banks. We've got regulations that force banks to restrict lending in a downturn. That's the capital requirement. One more, I could come up with more. Regulations that make cautious banks subsidize risky activities of incautious ones. So let's not talk about the free market here. I'm the last one to want to absolve the investors, the businessmen who were irresponsible. And I think that the first thing we want to do is make sure they take losses. But let's not get confused about the nature of the markets that failed here. To some extent, it is private market activity that's to blame, but to an important extent, it's the effects of unwise regulations of the past.
What he said, but plus also what I'll add to maybe more specifically answer the question is, people did talk about this problem dating back But the response was usually, yeah, but that's not going to happen because housing prices will always go up. And then they didn't, and as Professor Cummings says, chain reaction, downhill. As Professor Selgin has said, with these capital and accounting regulations, once that happens and you have devaluation, you have to stop lending. Let's keep in mind the bailout is about the credit markets, not the stock market. And so we have a freezing of lending caused by regulations that say you cannot lend if your capital dries up.
I hope I didn't mean to say that we were an unregulated economy. I agree with Professor Selgin that we have a great deal of regulations in place. The Sarbanes-Oxley regulation did not address the derivatives trading that I've talked so much about today. And I don't agree much with what the administration's been pushing out recently, but I do agree with what Cox and Bush have said recently in that we are trying to regulate a vastly changing market with 20th century regulations. And I think that there needs to be a recognition that these futures and derivatives markets are, when I was practicing, we had partners that would sit in their offices and dream up different types of corporate structurings and different types of derivatives tradings that they could engage in. And we just simply haven't moved with the times in our regulation. And so I agree that we need better, smarter, more effective regulation. I did not mean to indicate that we were an unregulated free market. We are not. We are just not regulated in the derivatives trading market, and we haven't kept current with smart regulation.
Hi, I'm Joe Bunn. I'm a 2L here at the School of Law. And my question is geared around more of a historical standpoint. If you look at Drexel, Burnham, Lanham in the 80s, Lambert in the 80s, if you look at long-term capital management in the 90s, if you look at Joe Schmo down the street that defaulted on his house, if you look at Bear Stearns recently, all those instances occurred because an entity borrowed money and invested it in a particularly risky asset. And I guess my question is, rather than arguing about adding or taking away regulation, should Congress be more focused on educating both people in business as well as the average Joe on what the implications of these assets and these new financial instruments that are being created are, and how to value the risk posed by these instruments, and how much they can invest in these? Thank you.
Well, I wouldn't want investment advice from a congressman. I don't know about anybody else here.
Yeah. These people went to school. They have MBAs. Some of them have PhDs. They were educated.
They were real smart. Yeah.
I think it has more. I think, as Professor Selgin said, it's about the incentives. And the same is true with the home buyer. The home buyer wants the house. They've got an incentive to buy the house. If they knew that they couldn't pay back, if the incentives were aligned properly, they probably wouldn't buy the house. I think people getting houses on subprime mortgages were not stupid. Some of them were defrauded, no doubt about it. But a lot of them figured that housing prices would go up and they'd refinance. It wasn't about education. It was about a bet. And it was not a good bet. And I'm not sure what educational program, other than be conservative, will change that bet.
Letting people fail and bear the losses connected to their own bad decisions is the best education that you can have. And the more government stands in the way of those lessons, the more reckless behavior you're going to get.
So to Professor Selgin, should this lesson be learned on Wall Street now?
Yes. I think these firms need to they're insolvent. They've made bad decisions. The thing to limit is the spillover effects from innocent third parties. I think that should be the only goal of any kind of regulation, interference, bailout, what have you. But the danger, particularly with the completely discretionary arrangement proposed in the original Polson plan, allowing him to decide what to do with $700 billion, when, after all, he was come out of Goldman Sachs, and those people, the old boy network is alive and well, and the Treasury, the Fed, and Wall Street. It's a revolving door. It was just almost inviting the reward of bad behavior to give him that blank check, as the media properly called it. By the way, to the comment concerning not wanting to sell out at a low market price, well, let's face it, the bailout also is part of the problem, the freeze. If you think they're going to bail you out at 30 cents, why would you sell to a hedge fund or anyone else for 20?
That's right.
And that's what a lot of these investment bankers and other troubled firms are banking on. They might well be selling to someone else if they weren't waiting to see if Washington will give them a better deal at Main Street's expense, at everyone's expense. So the bailout's part of the problem. I'm not saying that there isn't some package or involvement that might be desirable, but we need to recognize the hazard involved in having the government promise to invest our money to deal with this problem.
Hi, I'm Professor LaFaso. First of all, I'd like to thank the panelists and Professor Selgin. I never thought I'd say this, but I tend to agree with your very free market approach to this, which I'm sure my students are very shocked at. I have tried to avoid paying attention to the crisis because, as far as I can see, this is very cyclical, and I was not surprised when this happened. It seems to happen every couple of years, something like this. This might be worse, but what my main concern has been, and always has been in the last 20 years, is that there's some sort of bailout, something happens, there's a bailout. The taxpayers pay for this. Typically, as Professor Rich indicated here, they would be buying above market price. And then what I then try to do is think and compare this, well, what if there's no bailout? What happens? And what if there is? And what typically people ignore is the effect on the working class, all the workers who are going to be laid off because of this, and these other innocent third parties. And these effects have to be taken into account. Just like if you have a bankruptcy plan, you have to take into account all the different creditors, all the workers. Whenever you have some sort of plan for a bailout or for anything like this, when you have a distressed financial situation, you can't just focus on what has happened. You have to really actually have to think, like a chess game, well, what are the effects of this? And what I don't see ever, and what frustrates me, is the effects on, especially what I'm most concerned about, is the working class and the workers. So could any of you address at least a little bit of that and what you think about that?
Okay, I'll bite that bullet. I mean, the first thing to bear in mind is that in the best of circumstances, there's going to be a lot of general pain and suffering because a lot of the wealth that we thought existed in that housing market was, well, just a myth propped up by easy money and by other policies that kept that market going for so long and got it going so high. That's gone. That wealth is gone. The people who had the houses aren't as rich, etc. And that's going to affect a lot of people. That reality that no amount of bailouts can make go away is going to hurt a lot of people, including working people. It's going to hurt anyone who owns any part of these investments, and we all probably own some. If you've got some mutual funds, or you're one of the investors. And by the way, you need to take a hit because you made a bad investment and took a risk. Those things are unavoidable. The kind of spillover third-party effects I was talking about will add to the suffering of working people because they'll add to the overall contraction of the economy if credit does indeed continue to be dried up. And that means no credit available where it ought to go, which is for normal business, to keep normal businesses operating and so on. And of course, that means that businesses fail that haven't made any mistakes, and that workers get fired who haven't done anything wrong. That should be avoided, but the trick is to unlock the credit market, recognizing that credit isn't going to be as cheap as it has been. Unlock it without rewarding the people who made bad decisions. And that means doing something fancier than what Poulsen had in mind. And maybe not spending as much money as he wanted to spend. And maybe giving people an equity participation or whatever, which is now part of the revised proposal. But there's also 450 pages in the new proposal. 2 pages is really scary for any $700 billion expenditure. But if you know what most legislation Congress comes up with given time is like, 450 pages ought to scare you too. For a different reason. Because of all the junk that's probably in there. And we don't even know if the junk includes some basic improvements on the things we found abhorrent about the original 2 pages. So that's my partial answer to your question.
I would add to that, if the bailout were to not happen, the goal is to find a way to allow for credit where there is none now. So what those alternatives are, I don't know. Theoretically, I guess the Fed, instead of bailing out AIG, could bail out every small business that comes to it with short-term loans. The companies that will be hurt most are those who are borrowing to make payroll, et cetera. Those who are financing their operations on an ongoing manner without borrowing are not going to be as much by this crisis, except, of course, for all the other people who are laid off and stop buying services, and then they'll make less money, and then they have to lay people off. That's the chain reaction, I think, that Poulsen is saying he's worried about. Whether it's going to happen, well, my question 10 was, I don't know. If anyone else knows, they should let everybody know, because it's unclear. But I agree there are creative ways to do this without buying the assets, but I don't know what they are myself.
I have a tangential reaction to your question, Professor LaFazzo, and this goes to the point that Professor Sullivan just made about the Old Boys Network. Back in the Enron WorldCom debacle, when both of those companies, imploded, now the Old Boys Network doesn't seem to think or care about the working class or the workers. And I don't think that's ever going to change until we are able to diversify the Old Boys Network, to have you, Professor LaFazzo, sitting on a board of directors for a Fortune 500 company, to have Ms. Changa sitting on the board of a Fortune 500 company, until we actually begin to diversify with people that care about things different than the cultural monolithic elite I've been talking about. I don't see that that's going to change. And the Old Boy Network's been thinking the same way ever since we've been a financial power.
I know there are many hands up, but we are out of time. And at this time, I'm going to take our last question of the session.
My question is, banking panics, particularly in the 19th century, were common. What is the likely range if Congress didn't do anything? How bad could unemployment, for example, get? Because I don't think people have a feel for the range of events that could occur, that have occurred in history. A range of thinking about how bad it could be.
Well, perhaps not. The nature of bank panics, the old-fashioned bank panics, are not something that can happen so readily today because of insurance. That's the good news. People don't have to run to take their money out. The bad news is the banks still can fail. That's the danger. And the difference is when they fail now, they have to be either taken over by the FDIC or merged, or other prompt action has to be taken. The problem is if enough of them fail, the FDIC goes broke, and it's pretty darned close. And then, of course, taxpayers, once again, end up having to foot the bill. So banking panic isn't the problem. The problem is maybe we should be talking about taxpayer panic. And there's nowhere to run in that case, right? So that's the issue.
I'll add part of the new 450-page bill is the FDIC limit is going to be raised to $250,000. That should reduce any kind of panic, but if a bank fails, there's more that gets paid out by the FDIC.
And that it only encourages them when you insure. It needs to be. Deposit insurance wasn't a very good idea in the 30s any more than Glass-Steagall. We'll have another panel on that someday, perhaps. I'm sure it warrants it. But the fact of the matter is that when you and I don't worry where we put our money, then there's no guessing how much bad investment's going to go on. And don't just blame the bank managers. They have to follow us. If we go for the high-risk banks because we don't bear that risk, there will be more high-risk banking. And that's the problem with government guarantees. And unfortunately, they are sacred cows. No one wants to question implicit or explicit government guarantees of bank depositors. In fact, they're so far from questioning them that now we've got guarantees of investment banks and big shots. The guarantees need to be shrunk, not broadened. And that's what's wrong with this new legislation about deposit insurance. It provides more of the same sort of thing that underlies a lot of the problems that we've been seeing. Oh, did I just get the last word?
Thank you, everybody, for your time this afternoon.
Is the mic on still?
Thank you for